Bonds are supposed to be safe. So how is it that owners of a fund that holds nothing but U.S. government bonds lost 16% in just the last 90 days? When interest rates rise, the value of bonds decline. Long-term bonds, like the ones in the fund I mentioned, decline the most. That fund dropped because interest rates have gone up. The recent rise in rates has had a much less dramatic effect on our clients because of our preference for shorter-term holdings. They are far more stable, and they're good when rates rise because as the short-term bonds mature, they can be invested at the then higher rates. Now, it's not quite as simple as just buying any short-term bond or bond fund. One thing that our ongoing research has found is a number of funds that have large amounts of bonds that are labeled short-term, but are likely to be much riskier. The reason for this is a measure known as effective duration. It describes a bond's sensitivity to changes in interest rates. Now, there are many bonds that are callable. That means that the issuer can redeem them before maturity. It's similar to you or I refinancing a mortgage. By calling the bond, the issuer stops paying the higher interest. When interest rates decline, the chances of a call are much higher, and the calculation results in a shorter effective duration. Now, some funds that are categorized as short-term because of a small average effective duration are actually loaded with callable bonds. When rates rise, these securities can act like the longer-term bonds that their maturity dates would suggest. Now, most people, they buy bonds and bond funds based on yield. So Wall Street has an incentive to use bonds with larger maturities or weak credit profiles to try to eke out a little more interest and get more attention. Well, we're not Wall Street. We work directly for and only for our clients. We're here to protect their interests. We're going to go a little deeper. We're diversified, patient, and disciplined. We do not speculate with our clients' life savings. We're investors, not speculators. Now, we have much more to say about what our research finds and how to deal with higher rates in our quarterly newsletter, which is posted on the blog page of our website. It's listed under the title, Investments to Avoid When Interest Rates Rise. And as always, if you have any questions, we would love to hear from you.